In previous presentations, I gave you an idea of what the economic development of Latin America and Asia looks like. And basically, my argument is that in Latin America, we do not have a debt problem right now. What we have is a fiscal problem. We have a tax problem. And that is going to hurt economic growth over the next few years and make economic recovery slower than is projected. Then I reviewed Asia and discovered, first of all, that Asia is, well, what we all know, the fastest growing region in the world, even in the middle of the crisis. In the middle of the 2020 crisis, the only country that grew substantially and did not contract at all was China. On the other hand, the Asian countries have very little debt. They're lowly indebted countries. They have 30 to 40% of GDP debt. They have not had tax problems because the economy did not collapse, so there is no fiscal problem. And the economic projections are very high. We estimate China GDP per capita to meet US GDP per capita sometime between 2035 and 2038, now that the US economy contracted and the Chinese economy did not contract. Initially, that projection was at 2050. So it's come forward someplace between 12 and 15 years. And that is, of course, going to make the US-China relationship very tense. Now, what we're going to review is what's happened in the G7 countries, in basically Europe, but we also will cover Japan and the US, but it's basically Europe. Here, I want to just recall all the debt crises seen in history have the same shape. There's a rise in international interest rates, a simultaneous drop in export revenues, a fall in GDP growth and tax revenues, and finally there's cease payments. This time around, in the crisis of 2020, none of this is present. So this is not a debt crisis, in spite of what the Secretary General of the United Nations said, in spite of what the Georgieva of the IMF has said, in spite of all of the international press saying there is a debt problem, we all have a debt problem, we don't have a debt problem. This does not look like a debt crisis at all. It does not look like a debt crisis because when China shut down in February, and all industries around the world connected to the global value chains that start in China slowed down and then shut down. So this is the first time in economic history where supply shuts down completely. Nobody was producing anything. Initially in Asia, but that was in the first quarter of 2020. And when Asia opened up in March, the West closed down. So that's one problem. The second problem is, this is the first time in history when the world, not one country, not 5 countries, not the European countries, the world, shut down demand. People stayed at home for months, and that changed the structure of demand. And the combination of shutting down supply and shutting down demand produced a shortfall, a GDP shortfall, the world economy sort of bump, it fell, and it fell in the second quarter. That was a severe fall, was in the second quarter. Tax revenue suffered severely, and then some economies put monetary and fiscal policies in place, expansionary policies, to try to counterbalance the drop in GDP. And there are policies of, we will see right now, There, on the average for the G7 countries, it's roughly 6% of GDP. What's rather confusing is that the indicator debt to GDP jumped. It jumped by something like 20%. And the question was, why did it jump? And everybody's jumping up and down because that indicator jumped. The fact is, if you contract GDP, which is the denominator of the equation, the index jumps up, of course. You have a smaller GDP. So that's the problem. And what we have found also is that there is a lot more local currency debt in the world than meets the eye. It was previously argued that the debt was in US dollars and that the international market, basically New York, bore the brunt of the weight of the debt problems. What we have found in Latin America first is that the debt is issued locally, in local currency, mostly. The dollar side of that debt is small. In Asia, the debt is also incurred in local currencies. And of course, in the G7, it's incurred in local currencies, in euros, in dollars, in pounds, in yen. So we do have an international debt market, yes, but that's not the largest market. The largest market for domestic debt, for domestic public debt, is domestic. So the previous structure that existed until 20 years ago has changed. That's a major finding. Here you have the collapse in the second quarter of basically it's Europe, and no, it's all of the G7. Italy lost 27 years, France lost 17 years, the United Kingdom lost 17 years, Canada 7, Germany 6, Japan 9, the US 5, and the European Union on average 10. All of the G7 countries on average lost 7 years. This is roughly about the same as what Latin America lost. It doesn't look much worse. Latin America lost 8 years, 9 years, so it's a bit more. I have not done Africa yet. That's something yet to be done. But so this gives you an idea of the shock, the economic shock. Now, the recovery that followed was like this. In the third quarter, Italy recovered all that it had lost. France recovered 82% of what it had lost, the United Kingdom 65%, Canada 60%, Germany 57%, Japan 43%, and the US 33%. So it did not recover much, and it was recovered mostly by monetary policies. That's the green part of the bar. So it's mostly monetary policy that leads the recovery in the third quarter. This is what the governments did with fiscal policy. In Canada, it injected 19.9% of GDP in fiscal support. France, 10.8%, Germany, 8.2%, Italy, 13%, Japan, 14.2%, the United Kingdom, 16.5%, and the US, 18.5%. The G7, it's 14.5%. So when we speak of a region that has a potential debt problem, because the amount of fiscal support injected into the economy is the largest in the world, we're speaking of the G7 countries. We're not speaking of global South countries. If we in the global South did that, the IMF would have jumped saying that we were injecting inflation into the economy. So This I think makes perfectly clear we have two rules of the game in the world. No? One with which we analyze the G7 countries with these awful numbers, and the other one with which we analyze Latin America and Asia. Here you can see this is the G7 countries. It is also mostly domestic debt, as you can see, local currency. This is how the indicators jumped. 22% for Canada, France 14.6, Germany 14.8, Italy 12.2. Now these numbers jumped because that jumped. So here we have what the European numbers look like. So the economic contraction of the end economic contraction of the G7 countries has not been as brutal as the economic contraction of Latin America. What is peculiar this time round, with a crisis like the one in 2020, with a contraction of the global economy, is that raw material prices started to grow in March of last year, when the US Fed injected 15% of GDP in liquidity to investment houses. And then the US and European Central Bank interest rates were reduced to 0.25%. We then have a collapse of international trade, but it recovered in June. So, and we had something else which was strange. We had exchange rates that were depreciating between January and March. And after the injection of US dollars in March 23rd, we see the exchange rates appreciate again, which means the US dollar depreciated. As the US dollar depreciated, commodity prices in dollars went up. Here you have the currencies, and you have how it jumps up. Initially, all depreciate until March 23rd. Here you are. The only, and here we put the Russian ruble, the only currency that did not recover to pre-January 2020 exchange rates was the Russian ruble. Everybody else, the euro, the pound, and the yen, recovered and are now more appreciated than their exchange rate at the beginning of 2020. This is what the table looks like. What's in red is the jump in the index debt to GDP. And here you can see how it's a major jump, no? 98 to 117, 88 to 114, but most of this, in some cases, it's fiscal policy, as we just saw. In other cases, it's the contraction of GDP, and it's, of course, if you add one thing to the other, then you have, Greece jumps 25%. But that's not all fiscal injection, that's a contraction in the Greek GDP, and so on and so forth. The United Kingdom grew 15 plus 8, 23%, roughly. And that's the, 16% injection and the 9% contraction in GDP. So there you are. And the US jumped from 108 to 131. This is 23%. Yeah, this is roughly 23% jump, of which 19 is fiscal injection and 4 is a contraction in GDP. These are the projections made by the, this is the IMF projection. No, this is OECD projections. Here, this is not projection, sorry. This is the economy. This is the economy of the European Union. The green line, this one, is GDP, the actual GDP. And the blue line is the annual growth rate. And this starts in the year 2000. This is the first drop is the drop of the crisis of 2008, 2009, where the growth rate contracts to -5 and then recovers to +2. And this time round, as you can see here for the European Union, the contraction is a major contraction, contracts to something like 14% of GDP. That's a major contraction, and it bounces back. And here it is. The fourth quarter, it is in -5. Of course, from -14 to -5 is a massive recovery. But as you can see in total GDP in millions of dollars, constant dollars, the amount of GDP is shorter than what it was at the peak, just before the fourth quarter of 2019. So you have a Europe that has shrunk, a Europe that has shrunk, basically. Please take note of the inverted square root shape of the end of the curve, where the recovery has a slower speed, the blue line, than before the crisis, okay? So this looks like an inverted square root, and that means a slow recovery, a very slow recovery. Now, let's look at the IMF projections. No. Here we have the IMF projections. And here we have a proper square root shape with the right side higher than the left. Now, why is this? What the IMF says for the EU, that's the blue line, what they say in terms of growth is that the fall in GDP is followed by a bounce, and that the bounce will continue the same trend, the same trend line as the initial bounce. So that first bounce in the third quarter, when it bounces back up from -15 to -5, they say that speed will continue at the same rate all of 2021, and then it will taper down. Yet, what we see here is that the blue line in the fourth quarter does not follow this bounce. It doesn't follow the bounce. So my argument is, and was the other day in a discussion with people from the IMF, my argument is they are projecting their wish. They are not projecting the data here. This data does not result in that. And what that means is what they argue is that this tapers down and it goes back down to almost nothing in 2023, and economic recovery will be completed by 2025. What came out in the news was the bounce of 2021. That's the IMF reported a big bounce in 2021. That was the news. But the bad news is after it bounces, it's going to bounce back down. My point of view is it will never bounce back. Europe will not bounce back to 4% at all. What we're going to have is Europe bouncing back, yes. And maybe if it can make it to zero, if it can climb up to zero, that would be wonderful. But what you're going to have in Europe now is a stagnation. And if we look This is capital formation in Europe. This is in euros, in billions of euros. We have here a recovery, but this recovery is not here, right? So here we have a gap. And that gap is going to hurt. Here we have some countries, the one that invests the most, which is Germany. Germany's recovery to the fourth quarter, the investment, the total amount of investment, real money put down in investment, is below where it was before the 2019 beginning of the drop. So is the case for France. This was France before the fourth quarter of 2019. It fell, it recovered, but it has not recovered in the fourth quarter back to where it was. It's recovered here. And Italy has recovered to where it was previously, but Italy had all kinds of problems previously, as we all remember. They had no economic growth, properly speaking. What we found also is that the countries that grow the slowest are the countries that fall the most and that recover the least. So that the slow rate of growth stayed. You were growing slowly, you fall a lot, and you recover very slowly. And that's basically it. So in conclusions, what we have is a debt problem here. If there's one part of the world that has a debt problem, that's the G7 countries. They're all over 100%, almost all, except, well, Russia, but Russia is not a G7. I don't know where we put Russia. We didn't know where to put Russia. So we put it with Europe. But Russia doesn't have a debt problem, nor Finland, nor Germany. Everybody else has over 100% of GDP debt. And it is argued that this is not a problem because rich countries don't have problems, basically. That's the argument. They issue their debt in their local currency so they can restructure and manage the bonds in their local currency. The fact is, this is the part of the world that grows the least. So when we look at the G7 and we look at Asia, Asia is growing the fastest, the G7 is growing the least, and it's going to have the least recovery compared to at least Latin America, that will recover faster. Now, this will make for what I have called a change of economic axis. We have swung from the Atlantic basin to the Pacific basin very quickly. I mean, we were arguing some time ago that the Indo-Pacific basin was the new economic region of the world with dynamism. Now it's confirmed. Now the Atlantic basin is the basin where there is no economic dynamism to speak of, and they will fight for their lives not to lose relevance. Here, what we're speaking about is the irrelevance of Europe and Britain, and the loss of relevance of the United States in the world economy. And that's major. I think that's a very important change. Thank you very much.